So let's do a bit of a multiple time frame analysis. So typically what we're looking to do is trade for volume. But because we're trading for volume, it doesn't mean that we're just going to start hitting a button like a machine gun, open and close the positions, because we must protect the account. So an important thing to do is to understand what the market is doing for the week, the day, and so forth. And we do that by using multiple time frame analysis. So I trade supply and demand. For those of you that have been speaking to me, you know that supply and demand is the cornerstone of everything that I do. So what I'll do is I'm going to use supply and demand to draw my levels, as opposed to support and resistance, which is typically used by most people. So to give you an idea, with supply and demand and support and resistance, one of the key differences is that with support and resistance, traditionally they say the more time a level has been hit, or the more touches it has, the stronger it is, because it's proven itself more over time. But with supply and demand, it says that the more times the level's been hit, the weaker it is. The reason being is FX is an order-driven market. So as the level is hit, the orders are then soaked up. So the more times it's hit, the less orders there are sitting within the level. Yeah, which is also the reason why typically when the market hits a level and drives out of it, you'll find the second time it goes into the level a lot deeper to find the rest of the orders that are sitting there waiting to be filled. So let's press on. First thing I'm going to do is I like to go to my shapes and go to my rectangle. This is how I like to draw my levels. And what I do is I take just the wick. So you see the wick of this candle here. I take just the wick and I'm going to draw a box around the wick and extend it. Yeah. So you can see here that includes the wick. Okay. So this is our first supply level. When supply exceeds demand, prices will fall. It's basic economics 101. When demand exceeds supply, prices will rise. So I'm going to put another level in here just at the bottom. So again, get my rectangle shape and I'm going to take the wick. So you notice here what I'm doing is I'm using just the wicks. This is like a hint or a tip for you guys in order to get you better results. Yeah, I'm going to put another level in, and I know some of you will have questions on this. And if you do have questions, by all means, just give me a call. We can set up a coaching session and I can go through this with you guys in more detail. I'm going to put another level in here at this wick. Here. And then I've got one more here that I can see. So shapes, rectangle, and I'm going to take this wick here as well. Yeah. Right, so these are the levels that I can see where the orders are sitting at currently in the market. Yeah, and there's some giveaways here, by the way. The big green candles, the red candle driving in, then the big green candle driving out. It shows that there's orders sitting here in this level here. Yeah, we've got the big green rushing out again, big green rushing up. We have here is we have imbalance, and then we have a push to the upside to collect orders. So it will come down here to collect orders as well. This is euro dollar, by the way. So now from here, what we can do is we can then drill in to smaller time frames. So from here, once we've got the daily picture, we can go to our 4-hour time frame and do the exact same thing again. Just start drawing our levels in. So just to give you an idea, and we won't stay on a 4-hour for too long, just to give you an idea. If I now take the wick here and do this, you can now see. Let me draw this correctly. I'm just going to change the color of it as well so it stands out to say yellow. If I do that, you can now see, if I take that wick, you can see here the market's come back in, it's driven in. If I've got the right wick, bear with me 1 second, right, just check. No, I don't hear it. This here is the wick, yeah, you can see on this red candle, yeah. Okay, so if I double click this now, so I remove these dots, it means that now this won't move. The rectangle box won't move. So you can see here the market's driven out of it, it's come back in, collected any orders that were sitting there and then rallied off. At some point the market's going to drive in. The daily time frame gave us this big blue box here. The 4-hour allowed us to drill down into this box here, which as you can see is a lot tighter. We're not going to trade from the 4-hour, and we can continue drawing levels. What I'm going to do is just remove this level here for now. Typically what I like to do is go down to an hourly time frame. Now the reason being is that the daily price action, the 4-hour price action tends to be a lot alike, very much the same. So you could do your analysis from 4-hour downwards. Remember, what I'm showing you is what I do personally. Yeah. So I'll go to 1-hour time frame. and I want to start doing the exact same thing, putting in my my supply and demand levels or areas. So I'll start from the top, I take the wick, same thing again, and I extend it out. Yeah. Now this level here, we can see it's had a one touch. Yeah. If we had an order just below, one touch, two touches. Yeah. And then three touches, and it's driven off of it, but it hasn't yet pushed into the level. Now, why is that? The reason being is because we use just the wick. So typically, the way this is taught to be drawn is to take the whole candle. And if you took the whole candle, you'd say, wow, look at that, that's perfect. But why am I showing you like this? Because I found from experience that doing it this way, even if, so if my order was hit, my order would not get hit. Yeah. So if I use this line here, this red line, I'm going to just make this red line so it's so it's different from the others, basically, not dotted but almost, yeah. And then we'll leave it as red. It can be red for now. If that was my entry, chances are I wouldn't have been triggered. It's touched my entry, but it needs to push through it to clear the spread. So let me just remove this. Now, the reason why I don't put it down here, and I'm happy to miss out on that particular potential trade, just so you know, so even though we're doing multiple time frame analysis, I'm throwing a few extra pieces in here because it's important and key stuff that I think you guys should know. The reason being is because, say the market comes up into my level and does not hit my order, what have I lost? Nothing. But if it does collect my order, my risk on this trade, yeah, is only what? Roughly about 14, say 15 pips. Yeah. Whereas if I take the whole candle, then my risk on the trade would be closer to 20 pips. So it's a huge difference in terms of risk and reward. And as traders, we do look at risk and reward quite heavily, because when we risk something in the market, if the reward isn't a reward that's going to be worthwhile, basically, in terms of risk, then it's no point taking it, you know. So for example, you know, some people will go and they'll work at, for example, a company, you know, for 40 years, work their way up in the company and so forth, and you know, to them that's a good deal. But there's other people out there that won't do that. They won't work for somebody else that period of time. To them, it's too much risk, not enough reward, even if the company's paying 100,000 a year. You know, so it's always how we determine it differently. In trading, when it comes to trading, I'm looking for the riskiest trade to take, full stop. So as you can see here, you know, what we've got is we've got much lower risk here. So that's why I draw it this way, yeah. And if we see any trade opportunities, I can point them out to you as well as we go along. So let's put another level in. We've got another big, massive wick here. So let's put the level in here as well. And then we've got another wick here just underneath it. We'll put that level in as well. So what happens is when you start stacking levels on top of levels, they become stronger. But we're not trading off a 4-hour time frame yet anyway. So draw some more levels in. And I can see I've got another wick here. So I'm just going to draw that one in there. I'm going to put another one in as well. Now I'm going to take this wick here.
Hi, hello, good afternoon. Can I speak to Rod, please?
And draw that in. Yeah.
Hi, good afternoon. Mr. Dill, please speak to Aidan.
And I've got another one here that I'm going to draw in, because the wicks, it's important not to ignore the wicks. Even though people say it's not the real price action, all the price action's in the body, and the wick is just the overextensions and you know, the erratic price action, all kinds of different things I've heard. The fact is, I like to trade in a way that makes money and that works, and this works, you know. So to the downside, we've got no demand levels, yeah, saying that price should rally. So at the moment, the price is falling in the market. You know, if you had to take a guess and knew nothing, so which direction shall I be trading in, you want to be trading the market going down. So what you'll find more than likely at this moment in time, without looking any further, just on the 1 hour time frame, chances are the market's going to drive into here and then drive off again. That's what, 25 pips or so, yeah. But then we'd have to wait for that. It's an hourly time frame, so we'll just drill down again and we'll go into the 30-minute. Just have a look. Now look at the 30-minute. You can see there's no real levels for us to be considering to any great degree. You know, there's this here. What this is, just so you can see this. If I just zoom in a little bit, yeah, so you guys can see this. This is a drop. Here we get the indecision in the market, or we get the what we call the imbalance in the market, yeah. So if we just take this here, this area here.
Hi, this is Aidan.
for example, I'm just going to ignore the wicks for now, yeah, just to show you something here. So this here is the imbalance. Drop, we've got a bit of a base here, and then it starts dropping again, yeah. So as it comes back up, it comes back up in, and it does come in, collect orders and sell off, but there's nothing in this move, as you can see. Ideally, you want it to be pushing up a bit higher than that at the moment, but this is just to give you an idea. So by us drawing the wicks only, what we're now saying like, look, this is where it's actually fallen from. Look at the big red candle where it's fallen from, yeah? When it comes back up into here, I'm expecting a reaction of some kind. That at the moment is still 10 pips away. Where the market's strongly to the downside, it could well come here, hit here, and sell off. Now, when I see this, some of the questions people have is, which level do I take? Do I take the first level or the second level? I always take both levels. I take one trade here. So if I'm trading, for example, at 2 lots, I'll take 2 lots here and 4 lots up above. But then that's the conviction that I have in trading this type of way, trading supply and demand, because it's something that I know is so accurate. It works very well. So I trade it all the time. Beginning initially, you need to take your time with things and start slowly and build yourself up. Just as like driving a car. You start driving a car initially. I don't know how many of you recall this, but initially when you're driving a car, what you find is that initially when you're driving a car, you find that if you think back, if you're driving a manual, that is, you've got mirror, signal, maneuver. It's something that you need to you develop, isn't it? You develop skills and so forth in that way. And you get better and better and better. The better you become, the easier it is to drive. Not that I condone this, but you could be driving, you could be on the phone texting, eating a burger, women doing their makeup. It's a bit stereotypical, but just I'm not being sexist here. Just bear with me on this one. You get where I'm going with this, yeah? You develop the skill as you go along. The more that you do it, and that's what you're going to be doing here. So let me zoom back out again, so we can get a clear picture. And now what we'll do is we're down to a 15-minute time frame, as you can see here. Now we can start seeing what's going on in the markets quite clearly. So if I'm going to trade on the 15-minute, yeah, well, I can see here on the 15-minute, I'm looking for a sell opportunity. Yeah, that's what I'm looking for. The market clearly is in a downtrend. If I draw a line here, there'll be another video explaining how to draw these lines in a bit more detail. But if I draw a line here, for example, I can see this is clearly on a downtrend. Yeah, it doesn't need to touch all my tops and so forth. The market is going down, yeah? So you may have seen that some people, what they'll do is when they draw a leveling, a trend line, some people draw it like this. They don't use it as a trend line for trading per se, but this is how they'll do it. Yeah, they'll take it from the high to the low. So I don't know if you've ever seen this before, any of you, but from the high to the low, it gives you a clear direction. The market is clearly going down. So we're clearly looking for sell opportunities in the euro dollar until the markets give us something different. Yeah, so it may not fall for the whole day, but we can't. In other words, we're not looking to trade a 4-hour setup in 4 hours' time. We can trade what we've got now in front of us, what's in front of us on the screen now. And on the screen now in front of us today, euro dollar is selling off. I'm looking for buy opportunities in euro dollar. That's just the bottom line, yeah. And that's how I do my top-down analysis to give me a clear picture. So look, I hope that helped, because I also wanted you guys to see in terms of supply and demand as well how I use it. I'm going to just quickly show you something that happens when you drill down. So let me remove this here just to get it out of the way, and I'm going to remove this here as well. Double click there to get that out of the way, yeah. And I just want you to see something here. So I'm going to draw another shape here, and I'm going to change the color of this one, yeah. So let me zoom in so this is clearer. What I want is this wick here now. So I do that. What I'm doing is I'm drawing the wick here. So this is what you might call drilling down, yeah? So I'm going to change the colour so you can see it clearly. Let's go with this violet colour, yeah? So you can see this, right? So if I just go back a bit and do this, just to extend it. Now if I zoom into this and bring it up, you can see now my entry here is a lot tighter. So yeah, do you see that? That's the wick. Instead of using this level here from the higher time frame that has a range of 7.5 pips, I now have a range here of 3.5 pips. Yeah? So 3.5, 7.5 isn't a great deal, but if we consider in terms of just monetary values and risk value, 7.5 versus 3.5 is double the risk. So if you can half your risk by using a simple trick like using the wicks to draw your supply and demand levels, it's going to change your results quite dramatically, because now you're risking less to make more and catch bigger moves. Hope that makes sense, guys. I know this is a 15-minute video. I try to keep them all nice, short and sweet, but I want you guys to immerse yourself in this type of thing. It will change your results, I promise you that. Thanks for listening. Remember to like and subscribe so you can get all the updates as and when they come out.